Navigating economic uncertainty, investment opportunities and risks amidst market volatility. Hello everyone, and welcome back to our channel. Today, we're diving into the recent stock market crash, global economic uncertainties, and analyzing whether it's an investment opportunity or a time to be cautious. Let's get started. Warren Buffett's cautious approach. Warren Buffett, known for his investment wisdom, has taken a very cautious stance regarding the recent stock market crash. Berkshire Hathaway sold half of its Apple shares in Q2, reflecting his concerns about market volatility. Currently, Berkshire holds a massive $277 billion in cash, indicating that Buffett is reducing risk and waiting for better opportunities. He has also mentioned the difficulty in finding attractive investment opportunities in recent years. Ray Dalio's pessimistic outlook. Ray Dalio of Bridgewater Associates has presented a very pessimistic outlook for the global economy in 2024. He warns of political instability, high interest rates, and increasing debt burdening the economy. Dalio is particularly concerned about the U.S. debt levels, which could lead to an economic crisis if not managed properly. He also believes that high interest rates will continue, negatively impacting economic growth. Extreme warnings from Harry Dent and John Hussman. Harry Dent has issued an extreme warning about a potential bubble burst, predicting the stock market could fall by 50% to 86%. John Hussman similarly warns that the S&P 500 index is as overvalued as it was before the Great Depression in 1929, predicting a possible 50% to 70% decline as a necessary correction. Analysis from Capital Economics and Richard Bernstein Advisors. Capital Economics expects the stock market to rise another 20% before a bubble bursts, attributing the inflated market to excessive expectations surrounding AI-related stocks. Richard Bernstein Advisors, on the other hand, warns that large-cap stocks are overvalued and predicts a significant correction, cautioning against concentrated investments in a narrow group of stocks. In-depth analysis of recent stock market crash. The recent global stock market crash results from multiple complex factors. Let's examine the impact of these factors, including the Middle East war and interest rate hikes. Morgan Stanley's perspective. Morgan Stanley believes the stock market is overvalued, particularly the S&P 500 index. They warn that recent interest rate hikes and economic growth slowdown are likely to cause significant market volatility, especially impacting technology and mega-cap stocks. Goldman Sachs caution. Goldman Sachs cautions that the overvaluation of technology and AI-related stocks poses a risk. They emphasize the danger of concentrated investments in certain tech stocks, which could lead to a major correction. J.P. Morgan's prediction. J.P. Morgan predicts an 8% decline in the U.S. stock market in 2024. They cite high valuations, an aging business cycle, restrictive monetary policy, and geopolitical risks, particularly highlighting the impact of the Middle East war on global economic instability and energy prices. Bank of America's concerns. Bank of America points to interest rate hikes and declining consumer confidence as major issues. They forecast that economic growth slowdown and reduced consumer spending will negatively impact the stock market, with significant risks to the financial and real estate sectors due to geopolitical tensions in the Middle East affecting the energy market. Analysis of Japan's interest rate hike. The Bank of Japan raised its interest rate from 0.1% to 0.25% in August 2024, marking the second rate hike in 17 years. This signals the end of Japan's 8-year negative interest rate policy and the start of a new rate hike cycle, interpreted as a sign of economic recovery and leading to a stronger yen. 1. Economic recovery signal. The BOJ assessed that the economy is moderately recovering, and that wages are likely to continue rising. 2. Inflation control. Japan has started to experience inflation, necessitating the rate hike. 3. Global interest rate trends. The BOJ adjusted its policy to align with the global financial environment. Impact on the global economy. 1. Stronger yen. Likely to strengthen the yen, reducing the price competitiveness of Japanese exports while lowering import costs. 2. U.S. Treasury market. Higher domestic bond yields may prompt Japanese investors to shift funds from U.S. Treasuries to Japanese bonds. 3. Global capital flows. The rate hike can alter global capital flows, increasing financial market volatility in emerging markets. 4. Commodity markets. A stronger yen can stabilize prices within Japan and affect global commodity market volatility. Middle East conflict. The ongoing conflict in the Middle East has profound implications for the global economy and stock markets. The war has disrupted oil supplies, causing energy prices to spike and adding inflationary pressures globally. Higher energy costs increase operational costs for businesses and reduce consumer spending, slowing economic growth. Interest rate hikes and U.S. employment market. Major central banks, including the U.S. Federal Reserve, are raising interest rates to curb high inflation. Higher interest rates increase borrowing costs, reducing consumer and business spending, which can slow economic growth. Additionally, high rates make stocks less attractive, leading to capital outflows. The July U.S. jobs report fell short of expectations, heightening recession fears. This has raised expectations for the Federal Reserve to potentially cut interest rates, with markets pricing in a 78% chance of a rate cut in September. The anticipation of slower economic growth and potential rate cuts has significantly impacted the stock market. Outlook and final thoughts. Experts point out that the current market volatility may be excessive, but they stress the importance of a cautious investment approach. August is typically a volatile month, so investors should focus on portfolio diversification and risk management. Major securities firms recommend closely monitoring the economic situation and making prudent investment decisions. Thanks for watching. If you found this analysis helpful, please like, subscribe, and hit the bell icon for more updates. Let us know your thoughts on the current market situation in the comments below. Stay tuned and see you next time.